Welcome back to the Deep Dive. Today our mission is all about speed and precision. We're going to tear into the November 30th Vivimoney Daily Report.
Yep.
We want to pull out the absolute core truth on macro, stocks, and crypto. Just, what is the sentiment right now?
And the sources really land on a very specific phrase.
They do. Cautious stabilization plus waiting. Let's unpack that.
It's the perfect description. It really captures the friction in the market. On one hand, you've got sentiment warming up, risk appetite is improving.
Right.
But on the other hand, the actual cost of capital, central bank policy, that just hasn't moved yet. The market's at the starting line, but the gun hasn't fired.
Okay, so let's start with that cautious part. That takes us straight to the Fed. Everyone is talking about rate cuts. Is that liquidity easing actually here?
Well, if you were just reading sentiment, you'd think so. But when you look at the mechanics, the answer is a firm no.
I firm no.
Yeah. The expectation is there for sure. Futures markets are pricing it in. But actual market rates, bond yields, they haven't shown a clear, sustained decline. We are missing that distinct liquidity easing inflection point.
Explain that phrase for us. What's a true inflection point look like?
A true inflection point would be verifiable drops in yields. The actual cost of borrowing money. That tells you capital is getting cheaper. Right now, we just see volatility. Money is still expensive.
So that raises a critical point. If money isn't getting cheaper, how can sentiment be improving? Where's that risk appetite coming from?
That's the perfect question. And it's because the improvement is, well, it's only slightly improved overall.
Yeah.
And it's heavily concentrated.
Concentrated where?
Almost entirely in crypto. The bounce we've seen there seems to have its own internal momentum. But if you look at traditional stocks, the big indices, they're flat. The big institutional money is still sitting on the sidelines watching.
Which leads us right to volatility. This is the most fascinating part of the report for me. We're seeing a major drop in fear.
A synchronized drop, which is the key insight. The VIX for the S&P 500 has pulled back a lot. So panic in stocks has eased.
Okay.
And at the same time, Bitcoin's implied volatility has also dropped sharply.
And that synchronization is a big deal, right? Because crypto can often spike with fear, even when stocks are calm.
Exactly. This suggests it's an active positioning signal. The sources say it reflects anticipation for a potential year-end synchronized bull market.
So everyone's betting the risk of a crash is over.
Basically, yes. They're positioning for a scenario where everything rallies together into the new year. And the crypto fear and greed index, it's moved way out of extreme fear. So the panic is definitely receding.
So let's get into the engine of this sentiment shift. Crypto. What are the numbers looking like?
Well, Bitcoin confirms this idea of stabilization, not, an explosion. It's been oscillating in a tight range between roughly $90,000 and $93,000.
So it's consolidating.
It's consolidating at a high level. And for Ethereum, the stability is maybe even more important. It has held above that $3,000 mark for several days now.
Which is a huge psychological level.
A huge floor for the rest of the altcoin market. And then you see others like SOL and BNB showing just, slight oscillations. It confirms the whole picture. No collapse, but no aggressive surge either. We're waiting.
Now, the sources raised a really serious note of caution I want to hit on. It's about pre-asset projects like HYPE. What are we talking about here?
This is critical. A pre-asset project is basically pre-public market. Think pre-token launch or a private stake in a startup.
Okay.
The problem is a total lack of public data, low transparency, and almost no liquidity. You can't see the history, and you can't get out easily. The sources are basically screaming, be careful here.
Especially when the macro picture is still so cloudy.
Exactly. It's just too high risk for most investors right now.
Let's jump back to the traditional side. You said the big ETFs like VOO and QQQM are stable. But is that a good stability, or are they just stalled?
They're stalled. It's a passive stability. They are maintaining low volatility, sure, but they critically lack strong momentum. We're not seeing the aggressive buying needed to push to new highs.
So institutional money is just staying put?
Staying put, but not charging forward. It fits that cautious stabilization theme perfectly.
This brings us to the final piece of the puzzle.
Yeah.
The big one. The US dollar index, the DXY.
The gatekeeper, the key blocker.
Where is it at and why is it so important?
It's sitting around 99.46, which is a neutral to slightly strong stance. And this is so important because a strong dollar basically tightens global financial conditions.
It makes risk assets less attractive.
Well, less attractive, exactly. It sucks capital out of things like crypto and emerging markets. The fact that the DXY is holding strong is the single biggest reason that liquidity easing inflection point hasn't happened. That's why we're all still waiting.
That just clarifies the whole tension perfectly.
Yeah.
So given all this, what's the recommended strategy from the sources?
The strategy comes directly from the market state. Cautious stabilization plus waiting. It's basically a three-pronged approach.
Okay, let's take them one by one. First, how do we allocate?
Step one is steady allocation. With volatility down, especially in Bitcoin and Ethereum, the sources suggest considering a moderate configuration of those mainstream assets. You're sort of accumulating for long-term value while things are quiet.
And the second step seems to address those risky projects we just talked about.
It does. It's diversification. Disperse your capital. Avoid heavy concentration in any one thing, especially those illiquid, high-risk assets. You need that hedge against a macro shock.
And the final piece. What's our main job as investors right now?
The main job is observation. You have to watch two things: global liquidity and the USD index. If the dollar weakens, I mean really weakens below 99, and you see bond yields start to fall,
That's the signal.
that is the unmistakable signal. That's the catalyst that could finally unleash that synchronized rally in crypto and tech.
An incredibly clear breakdown. The market has calmed down, it's positioned for a rally, but everything hangs on that macro clarity. We're just waiting for the dollar to give way.
Exactly. And that leaves us with the final thought, the question you should really be mulling over right now. The market is pricing in this big synchronized bull run based on a weaker dollar.
Right.
But what if that DXY sitting there at 99.46 never really weakens? What if it holds firm? That gap between hope and reality could keep risk assets trapped right where they are, maybe until well into next year.
So the DXY holds the key to whether all this positive sentiment can actually become reality. Something to watch very, very closely. That's it for this deep dive.